Thank you everybody for coming after this lunch session. It's usually quite hard to really keep yourself awake, and you guys are coming to an intermediate session of digital securities, so hats off to you guys also. So a quick background about myself. My name is Arnab Naskar. I am the co-founder and the business lead of STOKR. STOKR is a digital securities issuance platform. We are regulated in Luxembourg. We recently got the regulatory license a few weeks back, to be very frank. It was an uphill battle in the process. But at the moment, STOKR is one of the leading players in the market of digital securities. We issued over 60 million worth of assets. And there are quite some stuff that we did is quite interesting, I think, for the audience also. This session specifically and how I would like to structure is a little bit interactive also. So I think I have 45 minutes. So I would like to spend 20 minutes talking and then maybe opening up for the Q&A and ask, some feedbacks or any questions that you have, and I'm happy to answer on that. If you cannot hear me in the back, let me know so I can be a bit louder. So please feel free. So the main purpose of the session today is to talk about the growth that we are about to see or what we are seeing right now in the digital security space, or specifically tokenized security space, right? And even in the bear market, we see very interesting deals happening. Big players like JP Morgans and others are also coming to the market. So there's a very interesting transition happening even in this current bear market, also global bear market in that sense, right? So before we go into this entire concept of digital securities or tokenized securities and how we are seeing the growth, let's go into basics. And I think this is the time where we can talk about basics and fundamentals, right? Everything from valuation to markets, everything is talking about fundamentals right now, right? On an abstract level, when in 1960s around Nasdaq and others came in, there was a concept that they brought up with was a dematerialized securities, right? I have not seen that era of, I would say, 1950s or 1940s or 1930s, but historically how securities used to be traded was you as an investor used to hold the paper certificates, and then the trucks used to go at settlement time, and then in the night they used to do settlements, right? And those settlements used to take 7 days, 6 days, 10 days, something like that. This changed drastically when the dematerialization concept came, and that's what we are using right now, is you have somebody you're relying as a CSD and those entities. There is a middleman, to understand in that way, who is holding your security certificates and ensuring that you have that ownership, right? So if you see fundamentally what happened was we moved from dematerialized securities, from the normal paper-based, complete custodian ownership, the bearer bonds market, howsoever you call it, to a dematerialized securities. From that era of 1960s till, I would say, 2015, 2016 or 18 even, there was no fundamental major shift in the securities market. But if you see the payments market, we got Bitcoin, we now have Lightning, we started with checkbooks, we got credit cards, we got Apple Pay. Payment infrastructure massively changed from technology perspective, from regulatory perspective, from user convenience and UX perspective, but not the capital markets. We saw definitely Robinhood, we saw Revolut, but these are kind of the front end to a legacy back end. And that's a problem we faced. And this is, I think, last year, we can all remember when the GameStop issue happened. Fundamentally, when you tried to, and if you are a GameStop shareholder or kind of a stockholder on Robinhood, and you want to withdraw, and that moment of volatility, you are not allowed to withdraw. And this is a very fundamental thing, because if your own ownership right is not being allowed to be enforced, what is the property right you have? This is the fundamental question comes, as in the current capital markets, do you really have an ownership or property rights in your stock certificates or in your securities? And this is where the fundamental, I see the transition. This is where I think the tokenization or digitization of securities market should look into, is how we bring back the concept of ownership that was there pre-1960s back again in 2018, because the same philosophy of Bitcoin, not your keys, not your coins, should be the same way in the securities market, is not your certificates, not your certificates in that sense, right? And this is where I think the transition is going to happen. And this is where the high level in Eagle's view, this is where the transition is happening from 1960s till 2017, as there was stagnation. This is starting to change. In 2018, this is specifically started, and we will see more and more and more of these things happening. So in that perspective, and there's another concept we need to see is concept of the Web 2 and Web 3. I mentioned about the concept of the property right? Let's say in the non-digital world, if you own a house, you have the keys, you have the physical possession, you can touch that, you can feel that. But in digital world, the ownership is very vague. It's abstract, it's theoretical. What is your digital rights in a Facebook metaverse, your avatar? What is your digital rights of an NFT, let's put it like that, right? The JPEG file, what ownership you have? The same concept is also in a securities market. When we are talking about digital securities or digital stocks, you are relying on so many middlemen, CSDs, brokers, transfer agents, and multiple custodians maybe, that if any single of them gets bankrupt or something happens, you are screwed. You are stuck there for months, maybe, and you cannot move. So the ownership concept, as we can enforce in the physical world, we cannot enforce the same in digital world. And there I think the transition is happening. This is where the transition of the economy we are moving, right? Web 2 is much more a role-based concept, right? If you are going to in the securities market, in that sense, you have a role as a custodian. So let's say I'm an investor, right? I invest in Flatex. If Germans are there, they know Flatex is the brokerage house where you can buy stocks. Interactive Broker is a platform many people have used. On those platforms, when you hold the certificate something, sometimes you are not holding just via one intermediary. There are multiple players in between, multiple brokerage houses, multiple custodians, multiple TAs. And this creates a level of intermediation, like the middlemans and this, counterparty risks that creates, right? And this is where the role comes in. And this is where historically, when we need to see is, when the stock markets evolved and this dematerialized securities, somebody had to step up as an organization who said, hey, trust me, I hold the security certificates, and as you brokers do not trust each other, I am entrusted to be trusted, and that's became the CSD. That's where the role of CSD came in. And this is the role. So everybody has a role. The transfer agent has a role to ensure this transfer has happened. Custodian has a role to ensure that, okay, this guy can custody a paper document in a much more safer way than me. The role of CSD comes, this guy can actually ensure the debit and credits are done properly. If one securities goes out, somebody gets it, one gets added, one gets subtracted. So everybody has a role, and this role costs investors money and issuers money. And this became, in the current stock market, if you see the IPOs is completely not there at the moment in the market. Because what is the reason? The cost to capital going through an IPO or public market is tremendously high because you have to pay so many middlemen. Now, if we bring this concept of and how we see the evolution, and this is because of the digital DLT space or Bitcoin principle, we are moving from a role-based world, from Web 2 era, to a ownership-based world. That's what Bitcoin gave fundamentally. And it's a conference about freedom. It's a conference about Bitcoin. And there I would like to stress about the ownership perspective. In the Bitcoin world, if you do not like, let's say you hold your Bitcoin in Bitfinex, you do not like their trading fees, you can take it out, goes to Kraken. You do not like that, you can go it out and go to Binance. This all can happen in matter of maybe few hours, maximum maybe in even half an hour, right? Try to do the same thing in stock market. Leave Robinhood for maybe few hours and then go to Interactive Brokers, then come out and go to something. You cannot do that. Nobody has the ownership of the securities. So that means when you don't have the ownership, you have to rely on all the roles, and then all this becomes a counterparty middleman. And that's what happened in the GameStop. That's what happened when all this volatility market kicks in. Citadel wants to trade behind Robinhood. In that case, you as a pleb are not allowed to trade because you have to take the loss because somebody has to make money out of you. And this is where the lack of ownership brings a problem. Because lack of ownership brings also the issue of Celsius, right? When you rely on a centralized third parties, you definitely rely on all the due diligences and all this legacy problems that entity has. So now as we're migrating from kind of concept of the role-based model to the Bitcoin's ownership-based model and the kind of understanding of sovereign ownership and your own property rights, things may look different in the capital markets world. And that's where the vision, and this is where I think the vision of digital securities market should be, is not try to provide every current intermediaries a role, but try to make things efficient so the current processes can be done at a much more lower cost and much more efficient manner. That includes regulatory efficiency, that includes definitely cost efficiency as well as time. Now, it's all theoretically good, you can bring the ownership concept, everything is fine. You want to remove the role-based approach, everything is fine. Now the question comes, does or is it possible to do it legally under the current laws? Because at the end of the day, we are talking about securities, right? We are not talking about ABC, banana coin or something which is just a utility, right? Which is not falling under any regulatory scope. These are securities by nature, and that means there is existing securities law. And there is very interesting, and this is what I think kind of at the moment, and this is coming back to our main topic, is why we see the growth in the UV market is also because of geopolitical. This is a very important thing, and with the current Russian war happening in the China-US tension and those things, Europe has a very interesting geopolitical opportunity to really revamp and re-innovate the capital markets and be a champion in the space. And this is a short window of time that Europe has, which need to be mobilized in that sense, right? So European capital market laws, and there are two things. If you want to do these digital securities, two laws and two regulatory regimes are very important. Often people talk about the left side, that is the capital market laws. Our MiFID II, our prospectus regulation, the new law that is coming, I will quickly come on that, is the pilot regime. But often a lot of people doesn't talk about the corporate law. And in certain European countries, if you try to add these two, then you can actually make the real, truly decentralized or ownership-based digital securities where investor can manage their own securities in their wallet. And that means in corporate law, it has to be allowing as an issuer, like for example, let's take a concrete example for Luxembourg here, right? Luxembourg has a very interesting corporate law that allows an issuer to manage their investor register. Now, when an issuer can manage their investor register in a simple sense, and this is not a law that coming today, it was very old law. Issuer can manage it on Excel sheet, issuer can manage it on a Dropbox, issuer can manage it on a DLT. Doesn't matter. Now, if you add that element and you add the European current MiFID, current prospectus regulation, you can actually, under European law, issue digital securities which are fully ownership based. That means those securities are issued in a pure form, in a token. And when you hold the token in your blockchain wallet, you hold the full ownership. And that's what we did. And this is, I want to go to a case study over there, is that's what is possible in Europe. In a lot of US countries, you still require transfer agent, you still require custodian. But why? The question comes is, in blockchain, if you do an atomic swap, the transfer agent is a smart contract in that sense, right? CSD is the blockchain by itself. And if the issuer has the own responsibility and a regulated responsibility, it perfectly works. And just to give you a perspective is, all the securities I'm talking about, these are currently defined under MiFID or MiFIR, the regulation, as transferable securities. So these are normal transferable securities which can have an ISIN number, right? So these are kind of traditional financial assets I'm talking. Now, one very interesting case study I want to highlight here in this growth story of digital securities is the Blockstream mining note. It's a very interesting instrument. The interesting instrument from one perspective is it's a Bitcoin derivative instrument, first of its kind. And the second, its interesting aspect is how it was issued. BMN was issued by Blockstream last year. They raised over 43 million till date in 8 tranches. And it's a very interesting instrument because that instrument allows an investor to subscribe for a fixed hash rate. The Bitcoin mines depends on a hash rate. I think everybody knows that part. If it's not, I will explain. Please let me know. This hash rate is fixed for a period of 3 years, and whatever Bitcoin is mined minus the cost goes to the investors. So investors get an upside of whatever Bitcoin is mined. Now, why this is very interesting? We saw yesterday the story of the Core Scientific. It's one of the biggest mining company that kind of in the stage of a bankruptcy. Why it is happening? Because miners or mining companies can be efficient, very good in mining, but sometimes they're trying to be efficient in mining at the same time, as well as be a hedge fund at the same time. And these are two different skills to have. That's the reason it's most of the mining companies are also facing a difficulty right now when the mining profitability is all-time low, equipment price is very low, hash rate is super high, Bitcoin price is low. So in that case, if your main business is to mine BTC and sell it in the market, you will be underwater. Now, what this instrument tried to do is differentiate these two risks. On one side, Blockstream as an efficient miner is mining. On the other side, the investors take the BTC price volatility risk, if you think this way. So Blockstream is not taking the risk of the BTC's price volatility. This goes to the investors because investors take the BTC after 3 years. So if an investor thinks of an accumulation strategy of BTC, perfect. Just give an example. If you guys scan the QR code, you will see a dashboard that was prepared by Blockstream that's updated on a live basis, on day-to-day basis, where you can see, and this is kind of the real world NAV, the net asset value, what we talk about in the fund industry, right? The NAV here is the mined BTCs. The moment a pool is being generated, this gets updated on a daily basis. So it's a live update, and you can see on real-time basis how many Bitcoins under one BMN. Now, just to give a perspective, and it's not an investment advice for everybody here. So one BMN was issued in the terms of SATs or BTC last year at 4 BTC, 2021 around June. Till date, around 5.1 BTC has been mined. And this is just above over a year. And there are still quite some years to mine. This kind of instrument is not there. We have a kind of hodl fund, like for example, Grayscale Bitcoin Trust, GBDC, where effective accumulation of BTC does not go up. That's capped. You're only relying on the BTC's price volatility. But in this case, effective accumulation of BTC can potentially go up. It's a very interesting derivative instrument of a hash rate, and it's crazy as it sounds, but is issued by a very traditional regulated vehicle from Luxembourg. We issued a Luxembourg securitization vehicle, which is a very sophisticated form of institutional grade vehicle. This securitization vehicle has the underlying asset, and the asset is a hash rate contract, which is represented by a note as a debt instrument because it's a 3 years instrument. And these notes are nothing but a token. These BMNs are digital securities and token. And when investors subscribed, they used, this was issued on the Liquid network. It's a sidechain of Bitcoin. Transaction fee is very low. Investors will not even see that. And investors got those tokens in their blockchain wallet, that is a green wallet. And they are also trading right now on a P2P basis in a decentralized exchange called SideSwap. And also it's being listed on Bitfinex Securities and few other platforms. Now, this is a kind of case study which I wanted to highlight is you have a traditional vehicle of a securitization vehicle, which is a very sophisticated, very commonly used in the capital markets world, but underlying asset is a very innovative hash rate and is brought out to the investors category for professional investors at the moment, but they can be traded on a P2P basis. And this is where the merging between the tech and capital market is happening. Because if you have to issue this in a traditional market, you would have gone to a broker, so you have gone to a custodian. If you want to trade P2P basis, they will say, okay, you have to wait for months, right? Because, the trading settlements doesn't happen. And if you're in the private market, forget it. You have to take a notary appointment and those things. And those who are from Germany maybe know how many days to take a notary appointment for certain transfers. So, and by that time, maybe the hash rate changes and your entire price point goes out, right? So this is where the value comes in, where we can actually, under current European law, issue under traditional financial laws an instrument that can not only survive in crypto market, but can also survive in a traditional market. Like hash rate derivatives, nobody tried to do that. There was some innovations somebody tried to do, but not in that level. And this and I met few people also who have invested in BMN and those things. It's a learning curve everybody is going through. We are trying to understand, and this is, this instrument is opening up so much. It's fascinating. Okay, I think I went back. Okay. So now when we talk about these issuances, we talk about one instrument like BMN and how this happened. And a lot of people now ask questions, and this is most of the time we hear also is, what about the secondary markets? What about tradability? How to trade those assets? Under European law, the CSDR is a little bit restrictive to trade securities because right now the CSD is Clearstream, and Clearstream does not take digital securities in their custody. So how can you trade securities? And this becomes a bit tricky question when you say, how can we trade a tokenized securities? And there are some brave people who try to do some centralized exchanges, going through different jurisdictions like Merge. Bitfinex launched Bitfinex Securities a few months back. Archax is an FCA regulated platform that recently launched. But on the other side, we are seeing also a growth of decentralized securities exchange, which you cannot see in the traditional market. In the traditional market, there is no concept of DEX for securities, right? But in the DLT market that's happening, there is SideSwap is doing very interesting stuff. XDEX is a new platform coming. Blockstream is collaborating with Poseidon Group and a few other players. So there are very interesting innovations happening. Now, this is a very interesting thing, and this I have to also share very transparently, is most of this exchange or centralized exchange innovation is not happening in Europe because of the existing CSDR laws. It's a bit restrictive. There is a very interesting law coming up, and I will come to the next slide on that. But the challenge is still there that even we can issue those assets under European law, trading it under a European secondary market at the moment is challenging. And this may be there for some months or maybe 1-2 years, but I see there is a hope. There are some interesting changes happening. So I think in that case, if we see how this market and this growth market is developing, you will see more and more we see issuances are happening from Europe, and few jurisdictions in Europe are becoming more popular. Luxembourg, Germany. We see also some things are coming in France. Slowly, there are some developments happening. Switzerland definitely is one part, as it's not a European Union. I will not bring that discussion, but Switzerland is also doing a very interesting stuff. At least in Europe, you cannot do full-fledged equity digital securities in tokenized format, but in Switzerland you can do it. So there is a very interesting added advantage also in this market. So a very interesting thing which I want to also highlight, and this is very positive for Europe, that we saw in the last few months, is there is a new regulatory regime coming called pilot regime. It came at the same time as MiCA. MiCA is the market and crypto assets regulation. So Europe is now trying to bring two different laws. One law is to regulate how you can, regulate the crypto assets, which are utility coins or payment coins. And the second law that is trying to regulate the trading aspects of crypto assets, which are securities, like what we are talking about, the digital securities, and that's pilot regime. The pilot regime is kind of a sandbox regime. It's a European sandbox, and I think it's very rarely Europe has its own sandbox, because every country usually in Europe try to create their own sandbox, and then you kill the innovation. Because if I have to only, as a business, only operate in France or in Germany in the digital market, the investment will never pay off. So it's better to have a European regime, and that's what the pilot regime is trying to do. There's definitely, the aim is to try to allow the existing MTFs or kind of a second grade, I would say, exchange or multilateral trading facilities to be the platform for trading securities. And they're also giving some kind of, innovation scope where centralized CSDs, as I mentioned to you, like central securities like depositors and others, can also run a tokenized CSD elements here. Applications process, I think, starts in March 2023. This pilot regime will be a sandbox regime for 6 years. After 3 years, regulators need to decide whether they want to continue or not. So it's kind of still in a, I would say, experimental phase. Also, the cap, if you want to operate, is not that great. So there is a lot of deliberations are happening. But it still, I would say, is a positive development to a certain extent, because at the moment, in the current scenario, there is no way to trade digital securities in a regulated platform in Europe. But with that, there may be some opportunities coming in from the next year onwards. And this is a very positive sign, because there are a lot of private capital markets that are stuck in, and they are looking for liquidity, because there is good platforms like Moonfair, ADDX, and all this kind of Web2 investment private asset platform are facing the problem of silos, because if you are stuck there and buying the assets there, you cannot trade it outside, right? But if you are tokenizing, you giving them opportunity that this kind of assets can come to the digital asset exchanges. And I believe most of the digital asset exchanges in next 10-12 months would have a securities license. And there, the ideal situation is those private capital markets will be traded, let's say, as a Tether pair with or BTC pair and those kind of things. That's, I see, the market development will look like. As I mentioned, I will stop here at the moment, so I will take some questions. Happy to answer anything.
Hello, is it working? Hello, thank you very much. It was very interesting what you were saying about the secondary market. So here in Switzerland we have a proper regulation in place, which is a bit more advanced than the European one, because it's not a pilot regime. But I think FINMA still has not issued a license yet. But I was interested in understanding what you think about the decentralized markets, in particular with the AML concerns, and what are, in your opinion, the best jurisdictions to set up such a decentralized market.
Okay, I think there are a number of questions in this. So let me address this AML concern first, right? I think you do not play with OFAC list and sanction list, right? So I think these securities will be issued in any jurisdiction where I see will be, ideally is issued in such a way that whenever somebody is buying the token and holding the token, the KYC is enforced. Or else, there are some structures where I'm seeing is where issuances and redemptions are only the KYC point, but in trading, they are not enforcing KYC. This, a lot of jurisdictions have different opinions, but if US comes in a very aggressive manner, things will change, This has to be enforced. So I see KYC aspect or the KYC issue in terms of digital securities will be low, because every entity that is managing the investor register has an obligation. Like STOKR is a regulated WASP, so we have an obligation for KYC AML. So that's, I think, definitely will be tackled. The decentralized exchange element, that's a very good thing, and I see a lot of people are trying to do some stuffs, and there is a scope, because where we saw the growth of Uniswap and those kind of platforms. Imagine you have some kind of platforms where you can do the treasury bill trade, or you can do, kind of private capital markets or private equity funds trading paired with Tether and something that can blow up the markets crazily. That's what DeFi has not even imagined. It can grow tremendously big in that regard, because you can do borrowing, lending, collateral big against, an instrument that has a financial backing, that has a kind of historical backing in that regard. So that's, I would say, quite gonna be a game changer in that regard. Any further questions?
Yeah, I was curious to understand from a risk perspective. Let's say that we have two instruments. One is equity or debt, whatever, on off-chain, and other one is on-chain. So on-chain, you have advantages like lower costs, less intermediaries, transparency, custody, blah, blah, blah. But you have a whole set of risks, like let's say that the blockchain you are deployed, the token on stops producing blocks, or smart contracts of this tokenized structure get hacked. So in your opinion right now, do benefits outweigh the risk, or for an institutional investor right now, it's too risky to issue a tokenized security, whatever, debt, equity, because of these things that in the traditional finance are operational risk, but right now they are the core risk of the digitized world?
I think risk and reward is a very interesting nomenclature, and this is where I think the institutions comes in quite a lot. And this is also, we spoke to a number of institutions, and where we see is definitely tokenization allows you to reduce significant amount of risk, because imagine the current setup, if you're managing a fund, the fund settlement is managed a lot of processes manually, and there is always a chance there is a human error, right? And you will take weeks to understand where the error really happened. That's also a big problem in the current setup, right? For example, if you're a big private equity fund, you cannot take a ticket size even for 50,000 or something, because you will have so many investors that managing those and their transfers, everything will be crazy, and you cannot charge them. But tokenization actually reduces that, because when it's digitized and in tokenized format, the blockchain register or the investor register recorded on a DLT cannot lie you. It is the truth. If there is anything mistake happened, you also see it, and it's on accountable basis. You can see where the mistake happened, and that's what I think the beauty of DLT comes in. I'm not telling the scams will not happen. I'm not telling people will not do the same criminal activities that doing the traditional market in this tokenized market. But what will be fundamentally different is accountability will be there, and you will see where it really went wrong. This is not possible in the current setup, because so many silos are there and so many sandwich middlemen are there. To understand where it went wrong, you will take months. So I would say risks are decreasing, to be very frank. Is there 2 questions there? Yeah.
Yeah, sure. So concerning the pilot regime regulation that are now coming in Europe, according to Article 1 and Article 2, this regulation will apply only to the MTF and CSD that are already authorized but according to the other European financial law.
Yep.
So don't you think that these provisions are a little bit too restrictive for the improvement and the development of this new technology on the market? So if I will open my new company that has as a goal to trade the securities, tokenized, the security token, I will not be able to do that in Europe because I have not the authorization as an MTF or CSD according to the European financial regulation. Just would like to have your opinion about that.
I cannot support you more on this. This is because I was in the part of the INATBA group, that was the association in the Brussels level, that was giving a lot of comments in the initial drafts of pilot regime and MiCA. And pilot regime was specifically kind of one of our focus is if you let the because at the moment they added one sentence and the new entrance they have added. Initially it was not there in the first draft, but it looks like you are allowing the existing incumbents to be only compliant and to be innovative, and for startups to be an MTF it will take years, right? So 6 years if it's the kind of the pilot regime scope, and allowing from 2023, 2 years goes to get the license and approval, so you have remaining 4. Yeah, I second you. This is where I see there's quite some limitations out there. The pilot regime is the main, I think, ethos and the principle in which it was put forward and it was, discussed, and the scope was there. It somehow got, some lobbyings went somewhere different direction, let's put it like that, and it went in a, very conservative approach. But still, I would say to have something is better than nothing, and there is already an opportunity that after 3 years, there is an option that ESMA can propose something and there can be some changes. So that's hopeful that they will see the value, because I see, below 100 million cap, a lot of small and medium-sized companies' debt or equity offerings can be really supported by this kind of regime. And this is where I would say the small growth cap MTFs really failed, where the pilot regime can make sense. But I totally agree with you. The scope need to be a little bit more startup friendly than incumbent friendly.
Thank you very much. MiCA and pilot regime are obviously capital market regulations. In contrast, at the very beginning, you have put much emphasis on property rules. And as far as property rules are concerned, we still have national regimes. Some countries see tokens as property, others don't see it as property. How do you overcome the challenges or these challenges with MiCA and pilot?
Yeah, I think MiCA is definitely not applicable for securities. It goes into complete different direction, right? And I totally I agree. Like, we don't have a capital market union in Europe, right? It's a very interesting structure, right? We don't have a pure capital market union. So there is always, even the corporate law, as I mentioned, right? Germany has a different corporate law setup than France, than Liechtenstein, than Luxembourg, and UK, and like UK is not anymore, but Netherlands and those kind of things. Where I see there will be interesting, and this is kind of interesting also to see the pilot regime, because Europe usually do not issue a regulation directly. This is the first time kind of they went without issuing a directive, they issued a regulation which is applicable immediately in 27 member states. This was kind of very historic in that, in my opinion, have 2 regulations at the same time. So that's, I would say, is a very interesting perspective. The second is the ownership concept, and this having this digital securities in your own wallet. A lot of national regulators agree. They don't see there is a big risk. We are talking to the regulators in France and Luxembourg, and our issued instruments have been already approved by BaFin and a few other. And we definitely explained them properly, and they also got understood. When you're enforcing whitelisting and you're saying, okay, any transfer need to be whitelisted, in that case, there is no way a sanctioned entities can actually hold the token, and for that they're fine. So at this moment, it's definitely is working out, but we need to see how, as it evolves, how it will look like. And how the different, because it's still not, details are not there yet, so there may be still some time we'll see something happening.
According to your experience, what are the major obstacles that an issuer has in order to decide to issue a tokenized security? So why should someone decide to issue tokens instead of the traditional finance?
There is very interesting, because there are 2 kind of issuers, right? One issuer, let's say you have a fund manager, the fund is already, 2-3 years down the line, and the fund will be another 10 years, right? And you believe a new generation of people and investors you want to target. In that case, keeping that fund purely in a traditional way, maybe you're restricting an audience. So what potentially can be done is, creating a feeder vehicle or something, tokenize that targets a different distribution channel, and that way you're targeting a traditional as well as kind of the new crypto-based audience, or kind of a new family office members and those kind of things. That's one strategy. Other strategy is you are targeting a complete, I would say, new audience, and new, let's say a fund that is holding DeFi, thesis, investment thesis, or fund holding, NFTs, or fund holding, different Bitcoins and different crypto baskets. Issuing in traditional dematerialized securities format is kind of goes against the ethos, right? You're holding on one side the assets that are Web3 assets, and the other side you're managing manually on an Excel sheet. Doesn't add up, right? So it's mouth should be there what you're speaking, right? And this is where I think this dichotomy need to be addressed. So there, I think definitely one scope. Challenge part, as you mentioned, is definitely there is a uphill battle because the wallet interface and wallet infrastructure is evolving. It's not so easy for a lot of people who are coming for the first time, and there is a lot of innovation need to be there. There is also, I see the exchange. More and more the DLT exchanges are coming in which can trade securities, and I'm expecting a lot of existing crypto exchanges will go ahead on that because they have a very sophisticated trading engine already. They have to acquire licenses in that regard. This will open up a very interesting audience because existing crypto assets investors are already quite, I would say, financially savvy. If they can do, margin tradings, atomic, options trading and those kind of things on crypto assets, they can also do in traditional financial markets assets. So there is a market.
Linked to that, but where does the consumer protection kick in when you provide a fund that is potentially accessible to everyone on the blockchain?
I never said it will be, at the end of the day, these are issued under the fund. If it's an AIF structure, alternative investment fund, it has to be, following the rules. Is it a fund for retail? Right now, fund for retails, even in normal traditional way, it's very hard, right? Tokenized is a different animal in that regard. So I still see these funds tokenization really much more for professional investors at the moment, those who can afford to lose money according to the regulators. But at some point, there will be, kind of small and medium-sized companies, equity debt instrument, because let's be very frank, if you're allowing people to gamble in the street without putting any restrictions on their education qualification, they can invest in some small and medium-sized companies where they're eating and going on day-to-day basis. So I think this level playing field should be there. Wealth creation is not a bad, and regulators doesn't need to babysit all the people. I think I have a few more minutes. Any?
Thanks, Arnab. Good talk. One thing you said is you had this analogy with crypto assets, right? You can, within 5 minutes, you can get your funds out of Bitfinex and send them to Kraken and vice versa, right? And you said it'd be kind of desirable to be able to do that for securities as well. But is that realistic even for securities? Because there will always be more restrictions, right? It's always going to be it's a highly regulated segment of investing, and even if it's on DLT basis, there will be registry service providers or issuers that will check if you actually, before they let you withdraw, right? Or they could claw back tokens, or they could freeze your address, right? There's all kinds of mechanisms that exist at the discretion of the issuer or the registry, the transfer agent, that can still, in this world of fast settlement and everything, can keep you from withdrawing your securities within a few minutes.
Yes, I think there will be still, because of the regulatory requirement, there are still some middlemen, but we are trying to reduce, instead of 5 middlemen, at least 2 middlemen, or 1, right? That's what we're trying to achieve. Now, let's say, for example, as a concrete example, when we did this BMN on Bitfinex securities, in this case, at the moment when investor is trying to withdraw, STOKR is actually the registry provider. So we do the KYC, AML on every investors who are holding those tokens or the BMN tokens in the liquid wallet. Now, if they want to withdraw from Bitfinex just takes the liquid address and puts it there. If it's not whitelisted, the transaction will fail. If it's whitelisted, transaction will go through. So in that case, they don't have to talk to STOKR, or they don't have to, do the KYC process. It's binary. If you're whitelisted, it's either yes or no. So if you're whitelisted, the transfer will take place. If you're not, transfer will not take place. And that definitely reduces some back office cost and definitely some management cost, but also it reduces the risks, because there will be no instance where the person is not whitelisted, but still get the token, because in that case, the person's wallet cannot exist, and it will not be in the registry book at all, and there will be no data whatsoever. So it cannot possibly happen. This kind of stuff, if we can enforce, and that's what actually reduces a lot of cost and increase a lot of efficiency, it can still bring a value add of tokenizing those securities. This is what we are trying to achieve, kind of reducing the middleman and making it more efficient.